What's up, people? It's Kenneth here with 100 Years of Wealth. Thank you for checking back. Thank you for clicking once again on the video. Go ahead and smash that like button. It's going to help us continue to grow the channel. Go ahead and press that subscribe button and request notifications so you get an update every time we upload a video. This video is going to be a very basic video, just giving you some basic information regarding how to get a loan to purchase a home. I realize that some of my other videos will kind of go into specific topics, but a lot of people just need that general basic information on how to get a loan to purchase a home. As we all know from all the YouTube videos that we've seen, or maybe not, but most people tout real estate as the biggest wealth builder in our country. And I think that that's an accurate statement. I've definitely said that before. So I think it's really valuable to know how to get into a home, why it makes sense for you, and how it's probably gonna help you build wealth as you go forward. So the simple answer to that, or let's start with the idea of how do most people buy a home, how that works. In the future, I'll start doing some videos with some charts and some some graphics so that you can see things laid out a little bit better. But simplicity is this. There's a house. Let's say this house is for sale in your city, and you like this house. It fits all the parameters: 3 bedrooms, 2 bath, backyard, 1 car or 2 car garage, a little front yard, in a nice neighborhood. That house is selling for, let's say, $500,000. You can either go the route of giving that person $500,000. Obviously, there's a process you would go through. You would use an escrow company to facilitate this transaction. That way, the escrow company is able to send the funds to the seller, but first paying off their lender or whatever debt they have against the property, and also facilitate the proper title information exchange, I guess you could say. Basically, you going on to the title of the property as a new owner, releasing the previous owner as from the title as the owner, etc. All that back-end information is usually handled by an escrow company. I think in some states it's handled by an attorney, but you would check with your local real estate professional on that. But point of saying that is that during a process of purchasing a home, you're going to be added to the title while the current owners are removed from the title as owners of the property. So that's all handled through escrow, through title insurance, through a title company, and like I said, in some states it's handled through a attorney. Let your real estate professional guide you on that. The things that you need to be concerned about is financing the purchase of this property, right? So you're either going to finance the purchase of the property through your own funds by paying all cash for this, let's say $500,000 property, or you're going to put a portion of that amount down as a down payment and finance the remaining portion through a lender, right? So the down payment requirements will vary per scenario. Some loan programs, let's say there are some conventional loan programs. Conventional, I've done a video on what conventional is. It's basically a loan that's backed by Fannie Mae or Freddie Mac. But there are programs that fall under the conventional guidelines that require as low as 3% down. Usually those programs are going to have some sort of median income requirement, meaning that your income needs to be lower than the average median income in order to qualify for the smaller down payment through a conventional or conforming loan, which is the 3% down. So in that scenario, if you fell under that median income average, they would only require a 3% down payment. If the purchase price was $500,000, that means that you would put down $15,000, 3% of the purchase price, and then the lender would finance the remaining 97%, which would be $485,000 in this scenario, and they would finance that on one mortgage, a conventional mortgage loan, at a particular interest rate depending on where the market is. So, but let's say that you did not qualify for the median income average, like your income wasn't below that, you're above the median income average, then for a conventional loan, the down payment requirement is going to be 5%, meaning that you would put down on a $500,000 home, you'd put down $25,000 and you would finance the remaining 95% of the purchase price, which would be $475,000. The rate would be dependent on the market, along with your credit scores and other qualifying factors, or mainly the market, your credit scores, and then the loan to value would dictate what your interest rate is. It would possibly vary per lender, but generally speaking, most lenders are going to be similar because they're all working off of the same market. But you do always want to take a look at a couple of different lenders just to make sure that one lender isn't really being aggressive with their pricing and charging you more than you could possibly get elsewhere, because that stuff does matter. Your interest rate, you might have one lender offering you in a 6%, or let's go a little lower. I think the market right now a little bit lower for that scenario, but let's say that one lender is offering you a 5% versus a lender that's offering a 5.25%. If all other factors are equal, let's say their closing costs are roughly the same, their origination costs are roughly the same, their discount points are roughly the same, then that quarter in interest rate is a true difference, and that will add up over the life of the loan, depending on obviously how long you keep it. But in reality, if everything else is the same and they're just charging you a higher interest rate because their business structure, their business model, or the pricing that they're getting from their investors, then you definitely are behooved to check and compare with other lenders and make sure that you're getting the best rate. You would obviously want to go with the lower interest rate in that scenario. But back to the point of this. So, let's say that you go with the lender that's offering you the 5% on that interest rate. You'll have your monthly payment, but regarding closing the transaction, you're going to finance that $475,000 at the 5% interest rate. It's going to generate a principal and interest monthly payment, and on top of that, you will pay your property taxes and your homeowner's insurance. So property taxes have a annual amount. Usually property taxes in most areas are paid in 2 installments. The way it works, once you impound those into your mortgage, they're going to be broken down into 12 payments. So your annual property taxes would be broken down into 12 payments and added to your mortgage payment. And your homeowner's insurance would be broken down to 12 payments and then added to your mortgage payment to create your total, what they call PITI, principal, interest, taxes, and insurance monthly mortgage payment. So in most scenarios, depending on what type of loan you take, but if it's a conventional loan, you're likely going to take a 30-year fixed loan. That means that interest rate and those payments are locked in for a 30-year period, 360 payments. So that payment will not change unless your property taxes adjust or your homeowner's insurance adjusts. That will adjust how much is going towards those items each month. Therefore, it will reduce or increase your mortgage payment. But besides that, interest rate's locked in, principal and interest amount is locked in. So if you put more down, if you put more than the minimum down, then that's going to positively impact your scenario, meaning that if you put, instead of 5%, you put down 10%, it's going to put you into a little bit of a better pricing bracket. And a lot of times, depending on the market, of course, that will possibly decrease your costs or decrease your interest rate for that specific scenario, because for the lender, they're looking at it in a less risky scenario, or they're looking at it as a less risky scenario because of the fact that you are now putting more down, lowering your loan to value. So if you're at a 95% loan to value, meaning that you borrowed 95% of the purchase price, a lender looks at that in a certain risk category compared to if you put more down and now you borrowed less of the actual purchase price. You're at 90% loan to value, you're at 85% loan to value, or you're at 80% loan to value, or whatever your down payment, wherever your down payment puts you, that is going to affect your pricing scenario because it affects your risk, your risk profile to the lender. The more you put down, the better for the lender. The higher your credit scores, the better for the lender. The lower your debt ratio, the better for the lender, even though debt ratio usually won't have some sort of an impact on your pricing scenario. It's really going to be your credit score and your loan to value that will affect your pricing scenario, unless you're going outside of like a conventional loan or a FHA loan or VA loan, where of course credit score, down payment matter, and they are direct impacts on your pricing scenario. But you also have other factors like your income documentation type. Are you doing a bank statement loan? Are you doing some sort of minimal documentation loan? Like I said, outside of conventional and FHA, because conventional and FHA are always going to require some sort of documentation of your income. So, like we discussed, we've talked about the scenario for a conventional loan where they allow a lower down payment because because you fit into a median or below median income average. Those programs are called Home Possible for conventional and Home Ready for conforming, which is Freddie Mac. So they have their unique quirks, but generally speaking, they are 3% down programs. The traditional conventional loan requires the 5% down. And then if you went FHA, that's going to require a minimum of 3.5% down. So once again, these are the minimum down payment requirements, but you obviously have the option to put more down, which will usually lead to a better pricing scenario for you. And just like an easier ability to get approved for the transaction. The more you put down, once again, it's lower risk for the lender. So, topic of discussion, buying a home. How's it work? So you put, once you identify the property, you identify the loan program, or you're speaking to a loan officer like myself. We identify what loan scenario is going to work for you. I'm going to ask you, how much money do you have to put down? You're going to let me know, okay, I do have 5% to put down. I have only 3.5% to put down. I have 3% down and my income is below that median average. And then we're going to say, okay, this program works the best for you. In certain scenarios, if a client doesn't have a lot of funds for a down payment, or they want to retain their funds for, let's say, closing costs or for future improvements of the home or for reserves, then we will look at exploring a program that offers down payment assistance, where a lender is going to give you 3.5% or 3%. It varies depending on the program, but the lender will give you funds for your down payment in the form of what's called a silent second. Basically, it's a second mortgage that goes onto the property, but they call it a silent second because you're not going to have to make payments during the life of that transaction. Usually they're going to expect you to probably pay that off before a 30-year period. So I think there may be some caveats where if there isn't a refinance during the life of the loan where you would have paid that off, or you don't sell the property where you would have paid off that silent second mortgage, I think at a 30-year period, a lot of those transactions or a lot of those loans are going to come due and require some sort of payoff. But the reality of it is that most people are going to refinance every 3 to 5 years in a good rate market, and 5 to 7 years in a market where the rates may be not so good. So, depending on the client scenario, depending on down payment and cash available, we'll decide whether we go the route of using a down payment assistance program or just using their funds for their down payment and closing costs. Closing costs will vary per scenario, but generally speaking, on a purchase transaction, you're going to see that closing expenses are a little bit higher than a refinance transaction, because some of the internal expenses for escrow are usually going to be significantly higher, but a lot of the other fees are going to remain the same. Notary charges, title insurance is usually reflective of let me take that back. On title insurance for a purchase transaction, from my recollection, and I'll have to check back on this, but the title insurance is going to be higher as well as the escrow, the closing fee. So Of course, double check that in your area, double check that in your county, and double check that with your title and escrow professionals, just to kind of be on point with that. But those fees usually do vary from a refinance. A purchase transaction will vary from a refinance, and usually be a little bit higher. But just for, let's say, a $500,000 transaction, rough estimates, just a ballpark figure, you're probably looking at around $4,500 to $5,000 in your base closing fees. Your title insurance, your escrow fee, which is like the escrow company that's closing the transaction, your notary fees, your endorsement fees, your sub escrow fees. There's a bunch of little miscellaneous fees, or a bunch of little fees that are part of a purchase transaction that total up to be around that $4,500 to $5,000, possibly a little bit more, for a loan amount of around $500,000. Obviously, if it's a lower loan amount, some of those fees will adjust down. If it's a higher loan amount, some of those fees will adjust up. So those are fees that you're going to have to consider. And you may have heard of things before where it's like zero closing costs or reduced fees. The way that works is a lender will sometimes offer reduced closing costs if they are able to, or it's going to depend on the interest rate that is being provided. So let's say that there's a par interest rate where the lender doesn't have some sort of additional yield spread on the back end, then that represents that they're not offering some sort of a credit at that interest rate. Like the way that someone is able to offset your closing costs or eliminate them is by basically giving you a slightly higher interest rate than the par rate, where that interest rate is going to offer some sort of a yield spread, some sort of a credit back that can be applied to your closing costs. And not really applied directly to your closing costs, but applied to the overall settlement cost of the transaction, offsetting the amount of fees that you pay. So the lender says, hey, our par rate is at 5% right now, but at a 5.25%, we offer a credit of $2,500. Obvious reason is because at the higher interest rate, the lender makes more over time, and can sell that loan on the secondary market at a higher compensation or commission to themselves, because of the fact that it's at a higher interest rate. So in turn, they offer a credit to the client, which can offset some of their closing fees. So in certain scenarios, you are able to have reduced fees, or in this scenario, let's say that we were able to get a $2,500 credit that could be applied to that roughly $5,500 in closing costs, therefore overall reducing the bottom line number for settlement costs for the transaction. So let's just kind of like forget about that credit for now, but just think about, okay, you roughly have around $5,000 in fees. The other amounts that would need to be brought to closing by a client are going to be related to the buildup of their escrow account, if they are paying their property taxes and insurance along with their mortgage payment, which most people do. The way that works is that you're going to have to establish an escrow account within the lender that starts off with at least a few months worth of your property taxes and a few months worth of your homeowner's insurance in that account. And then each month that you make a mortgage payment, they're going to collect a portion of that payment that's already been allocated for the property tax and insurance, and they're going to put that into escrow account so that later on in the year, when your property tax installment is due, they have the funds there to send off a check to your county to pay your property taxes. And the same thing when your homeowner's insurance is due each year. They have the funds in that account because they've been taking a small amount from your mortgage payment, putting it into that account, and then sending it off at the proper times throughout the year to pay your homeowner's insurance and your property taxes. So up front, a lender is going to establish that account with a few months worth of your property taxes and insurance, according to when the actual payment is going to be due, so that they have the accurate amount in there. So that's the other amount that you need to consider when you're thinking about how much I'm going to have to bring to closing to close this transaction. You're going to have your Fees on this transaction are roughly $4,500 to $5,000. Of course, if there's discount points associated with the interest rate, then those fees would adjust. If there's origination charges associated with the broker or mortgage lender that's doing the transaction, those fees could adjust. But I'm just talking about your base, true, actual hard fees that are related to the transaction. The prepaid taxes and insurance that are going into your escrow account, into your impound account, it's going to vary depending on when those amounts are due in your county. So for instance, here's a quick breakdown just so you can kind of get the idea of how that works. So right now we're in the month of July. In California, property taxes, or in LA County, property taxes are due in February and November, if I'm correct. I always say if I'm correct because I forget things, but February and November, right? So they are due in November, but they're delinquent, I think, in December, or they're, double check that on your own, damn it. But basically, the installments are November and February for property taxes in Los Angeles County. So let's say that my lender has to send off a check to, or not my lender, let's say on this transaction that we're closing out, the lender is going to have to send off a property tax installment check that gets to the county by November so that they're not delinquent, right? So that means that they're probably gonna wanna mail that check off sometime in October to arrive there in November. So right now we're in July. If we close this transaction in July, the client's gonna skip their August payment and their first mortgage payment will be due September 1st. So that means the lender's gonna have September 1st and possibly October 1st payment to be able to collect a small portion of their, or a portion of their taxes to send off the check to be there by November. But reality, they probably won't even be able to collect October's payment before they send off that check. They're gonna wanna send off that check probably early October so that it's on time in November. So that means that they only have literally one payment after we close our loan transaction in July to add to how much they're gonna send off to the lender. So what that means is that at closing, if you have a 6-month installment due in November, and we're only gonna be able to collect one installment or one piece of that, one portion of that installment through one payment that's gonna come in September, that means that you need to have at least 5 months worth of your property taxes in that account at closing so that you can send off the proper 6-month amount to be applied to your county property taxes in November. So I hope I didn't move around too much on that. But even in the scenario where the lender's like, okay, hey, it's gonna take we need 5 months to establish this account because we're only gonna get one payment between now and the time that we have to send it off to the county, the lender usually is gonna want some sort of buffer in there. So if it's, if they know they're gonna need 6 months, they have 5 months, or they have one payment in between now and when the property taxes are due, they might still collect 6 months at closing just so they have a little buffer in case something was off, in case there was some sort of fee that needed to be paid out of your escrow account. So if your property taxes, just for easy numbers, are $500 a month, that would represent taxes of about $6,000 for the year. That means that when they collect those 5 or 6 months at closing, they're gonna collect $2,500 to $3,000 for your taxes into your escrow account. They're also gonna pay your full annual insurance premium at closing and then collect a couple of months worth of that so that next year when it comes due, they have the full amount in there. So in this scenario, we're probably looking at somewhere around $4,500 to establish the escrow account. So just think about that. If you have $5,000 in rough normal fees, and you have another $4,500 in prepaid taxes and insurance, that right there is around $9,500. And then you probably have an estimated 30 days worth of prepaid interest. Because once you close your loan, you're going to skip your mortgage payment. You're going to skip that first mortgage payment that would have covered the interest, because mortgage interest is covered in arrears. So if we close a loan on July, let's say right now, July 7th, That means that the lender is going to collect interest at closing from July 7th all the way to July 31st, because you're not making a payment on August 1st. And the way that mortgage interest is paid, it's paid in arrears. So your payment that you would have made, because you are in that property after July 6th, your payment on August 1st, or you are in that property as of closing July 7th, your payment on August 1st would have covered interest from the time you close all the way to the end of the month. But since you're skipping that payment and you're making your first mortgage payment on September 1st, that interest needs to be collected somewhere, and it's collected at closing. So on top of your rough $5,000 in closing costs, on top of your roughly $4,500 in build up for your impound and escrow account, it's the same thing. You're gonna have whatever days of interest from the day you close all the way to the end of the month. So it varies. The closer you close to the end of the month, the smaller that amount will be. If you close mid-month, you're gonna have half of the month's worth of interest. So just consider that. So in this scenario, if we were to close now and have 23 days of prepaid interest added to our closing statement, I don't really know that exact calculation off my head without having an estimated interest rate, etc. But let's just say another $1,500 worth of prepaid interest on top of those closing numbers. So in this rough scenario, if there weren't any origination points, if there weren't any discount costs, you're probably looking at somewhere around $10,000 that you would have to bring to closing. Or I think in this scenario, we're looking more like $11,000 that you would have to bring to closing on top of your down payment to cover your closing expenses or settlement costs. So keep all that in mind. These are things to consider on how, when buying a house. So also keep in mind that all those funds don't have to directly come from you. Conventional FHA and most loan programs will allow you to use a gift, right? So a gift could come from a close friend or family member. A gift can come from an employer in some scenarios. But you could use a gift to cover closing costs or down payment. So the way it works is, let's do a little backtrack. You have your $500,000 house. You're going to go with a conventional loan. You're going to put down your 3%, or sorry, let's say your 5%. There's $25,000. You're financing the remaining $475,000. So you have your 25 grand. You have your $11,000 in closing costs, and then you have some money to the side for future reserves and payments. In this scenario, you're probably looking at about $36,000 out of your pocket if you're not using any down payment assistance. If that money is going to come directly from you in a bank account, just cash that you have in your bank account, a lender is going to want to see that that money has been sitting in your account for at least 2 months. They want to look at your, if we're closing in July, they want to look at your June bank statement, and then if we're closing this early in July, July 7th, they want to see that that money was sitting in your account for June as well as May, right? And that way, they're not going to ask you any additional questions about where those funds came from. Now, if they see a deposit in May at some point, or they see a deposit in June that contributes to that overall amount that's needed to close, then they're going to want to do what's called sourcing those funds. They're going to want to make sure those funds are coming from a usable source, whether it's your employment, whether it's funds that you took out of a let's say you sold some jewelry and you put the funds in there. They're going to want to see a paper trail on that. They're going to want to probably see an invoice for where you sold the jewelry. If there's a Zelle or a Cash App or a Venmo or some sort of electronic transfer going into your account, they're going to want to source where that's coming from. If it's coming from a friend or family member, they're going to want to know if that was a gift or if that was a loan. And if it was a gift, you need to have a gift letter to document that information. Or if it was a loan, you would need to have the full documentation of the loan terms. And if there's a payment associated with that loan, the payment information, so that loan can be added to your actual liabilities. So just consider that a lender considers your funds seasoned if they are in your account for at least 2 bank statements, 2 month cycle. If not, they're gonna wanna source those funds and make sure they are from usable sources. So, I don't really stress so much over that because I assume that most people aren't, getting money from like terrorists or like some sort of stolen funds, right? So most of your funds should be able to be documented, right? It's either from another account that you transferred it from, it's either from your employer, it's either someone paid you funds back from money that you let them borrow, or it's mattress money that you were sitting on and you pulled it out and deposited it into the account so that you can use it for this transaction. If that's the case, if it's mattress money, if it's funds that came from someone that borrowed, that you borrow or you allow to borrow funds, you probably want to have that sitting in there for at least that couple of months prior to starting a transaction, so that it's not, over scrutinized. Because if it's mattress money, depending on how much it is, it can only be a certain percentage of the actual down payment or the purchase price of the property, and it just creates additional layers of verification for funds that might legitimately just be cash that you had. The best bet is to kind of have a little foresight on that, and if you are going to be using funds that are sitting somewhere without documentation, your best bet is to put it into your account as soon as possible so that it gains that seasoning by the time you're ready to go into a loan transaction. So, once you have your funds verified from the source that you plan on using it from, you would provide that information to your lender. The lender would go through the process. Usually it takes about 30 days after you have opened up escrow. Open up escrow meaning that you found a property, you and your real estate agent has presented terms to the seller side has accepted the terms. Now, the contract is fully executed and we're opening escrow. Most escrows are about 30 days from start to closing, where you're wiring your final closing funds to the lender and or to the escrow company to close out the transaction. Once it funds and records with the county, the other side of the transaction, the sellers will give you the keys to your new home. But you're basically, just to give a little run back, you guys sign the contract. Next step is you're gonna wire in funds, your earnest money deposit into the escrow company to officially start the transaction. And earnest money deposits vary. They could be 1%, they could be 2%, they could be 3%. They can just be a flat dollar amount. Hey, $5,000 is what we're depositing. Depending on how competitive the transaction is, meaning how many other offers the seller was getting, that'll kind of dictate how aggressive you need to be on your earnest money deposit. If I'm going into a transaction where I know a bunch of other people are bidding on the property or putting in offers on the property, then I'm probably going to put in a 2 or 3% earnest money deposit. But if not that many people are really going after that property, then I think you can probably have a strong offer with still having like a 1% earnest money deposit. You wire your funds into escrow, start the transaction, and then that would basically allow your lender to start the process of closing your transaction out, order your appraisal, sending you out loan disclosures, all the basic steps within the loan. And then, prior to closing the loan transaction, your lender is going to present you with closing docs that should represent what or they are going to represent what your loan is, but they should match up to what you started the transaction with. You verify that information, you sign closing docs, and then after you sign closing docs, you would wire the remaining funds into escrow. Meaning that if the total amount to close the transaction was, let's say, $35,000, but your earnest money deposit was $10,000, that means you're going to be left with a difference there, because that earnest money deposit is going to be credited towards the closing costs. So up front, you're going to deposit, let's say, your $10,000. At closing, that will be credited towards the overall amount that needs to be brought to closing. So then you would have a short to close amount, or a funds required to close amount, and then you would wire that in. So sign loan docs, wire in your remaining funds, lender funds the loan, After the lender funds the loan, the title company records the transaction with the county. Once the transaction is recorded with the county, you are the owner of the property, and your agent would coordinate with the seller's agent to figure out when you guys can exchange keys, and then it's your property. There's a lot of detail within all of that, but I really wanted to just do like an outline and an overlay for people on how it works. It's, you know, I think that when you've never done the transaction, it seems like a very big process and a very confusing process, but it's really not. You know, just like you would qualify for to rent an apartment, you're basically going to submit an application. You're going to provide income documentation to the other party. The other party is going to review your income documentation along with your credit documentation and determine if you qualify for, you know, renting that property, or on a loan side, if you qualify and you meet the loan guidelines for the lender to provide you funding for this property that you're trying to purchase. So, you know, the first step is understanding that you don't have to have perfect credit. You don't have to have 20% down. You sometimes don't even have to have any of your own money down. You can use a down payment assistance programs, and those programs don't even require really high credit scores. So a lot of times people have in their mind, there's these like really, you know, strict, hard requirements to get into a property, and there's really not. You know, if you have decent credit, if you have 2 years employment history, if you have a small amount down or not, you know, and in other scenarios, if you have a lot down but without the employment history, you can qualify for a loan. You know, you can be a person that has 20% down but no current source of income, but you have assets and reserves, and there are lenders out there that could facilitate a loan for that. So best thing to do is, if you have any additional questions, email me or drop a comment or respond to it. Reach out to your local realtor or your local loan officer, because there's options out there, and the main thing is affordability. If you can afford to make your mortgage payment, then there's probably options out there for you to get into a property and start building that equity, start paying down your mortgage as your property value increases. That's obviously a market-driven thing. We don't know, you know, especially in this market, we don't know how fast or how slow your equity is going to grow. We don't know if you're going to slightly dip. You know, things do change, but by you paying down your mortgage, and you know, the reality of it is that most likely you're going to slightly see you're going to see your property slightly increase over the years, sometimes faster, sometimes slower, but in most markets we have continually seen a, you know, steady increase in property value throughout the years. So paying down your balance, slight increase in value, that creates that equity space, and that is how people start to build wealth. You know, you build that equity space, and then you decide, hey, maybe I want to sell this property, take half that equity, put it in my pocket, take the other half, put it down on this new property, and now I'm building wealth, and now I've upgraded my property. You know, that's how real estate acts as a huge wealth builder for most people, you know. So keep all that in mind, like and subscribe. I need to go eat some lunch because that was just a big 38-minute drop of information, but I really do hope it helps you, and hope it cleared up a little bit of how buying a house works. Once again, there's a bunch of other details along with that, and a bunch more information and little specific topics. I've probably touched on it in a couple of different videos, but if you have any additional questions, you can definitely email me or direct message me, make a comment, I'll respond to you, and hopefully I can help you out. 100 Years of Wealth, streamhomeloan.com. You guys have a great day, and go out there and do something.